Okay, we're going to finish Chapter 8 with a problem. It's problem 1A, and it's entitled Allowance Method Entries. The following transactions were completed by this company during the current fiscal year ending December 31st. Number 1, record the January 1 credit balance of $26,000 in a T account for the doubtful accounts. All right, so if you see here, here is our beginning balance in the T account. Number 2, journalize the transactions. Post each entry that affects the following selected T accounts. Here we go, the allowance account and the bad debts account. All right, so let's walk through these. So February 8, received 40% of the $18,000 balance and wrote off the remainder. So 40% is $7,200. Get rid of the $18,000 sitting in AR. The balance goes to the allowance account. The 27th, reinstated Seth Nelson, which had been written off, journalizing the receipt of $73.50 in full payment. $73.50. So we will put it back into AR, put the allowance account back to where it was. Now we take it into cash and we remove that AR balance. So put it into cash and take it out of AR. August 13th, wrote off $6,400. $6,400 write-off goes to the allowance account because we're doing the allowance method, and AR goes away. October 31st, reinstated Crawford that had been previously written off. It was a $38.80 payment. All right, so again, just like this entry up here, we will first put it into AR, replenish allowance account, debit the cash, and take it out of AR. And then on the December 31st first entry here, it says wrote off the following accounts as uncollectible. 1, 2, 3, 4 different companies. 1, 2, 3, 4, all the allowance. Okay? And then the last 31st, it says based on the analysis of $1,785,000 of accounts receivable balance sheet approach, we do care about the account balance. It was estimated that $35,000 will be uncollectible. Okay, so after we put all of these journal entries that affect these two accounts in there, here we are writing off, here we are receiving it again, and it says here as of December 31st we had an unadjusted balance of $3,170, and they told us they want us to have a balance of $34,700. And this is a debit balance, and this is a credit balance. So we need to book a $38,000 credit, $38,870, and then we will have an ending balance of $35,700. So our adjusting entry is a debit to bad debts expense for $38,870, credit to the allowance account, which then gives us an adjusted balance of $35,700. So that basically takes care of steps 1 and 2, and then step 3, it says determine the expected net realizable value. All you're doing is taking AR minus your allowance account, get you your net. In this case, it would be $1,749,300. Assuming that instead of basing the provision on uncollectible accounts on the analysis of receivables, that balance sheet approach, the adjusting entry on December 31st had been based on the estimated expense of 1/4% of sales. Income statement approach, we don't care. So then all we do is we take 1/4% times the sales, and we would just book $45,500. Not care about what it ends up with. We just book $45,500. Letter B, what is the balance then in the allowance account? Well, it had a debit of $31.70, and we just booked $45,000, so we're going to have something less, $42,330. And then what's the net realizable value? Again, full AR less the allowance, this new $42,330 would be your net. That takes care of all of the exercises and problems from Chapter 8 on receivables.